Gutting Eduardo Saverin's equity required only one silent flick of the pen. 8 years of loyalty vanished into a $600 million corporate black hole. Yet you are falling for the exact same extraction every single April. A tax refund is not a windfall. It is an interest-free loan surrendered to the state. Reclaiming your leverage requires the same cold-blooded precision used in the mechanics of professional dominance, the most effective theft. We see this play out through the 1943 Current Tax Payment Act, a masterclass in behavioral conditioning that permanently shifted the American organizational hierarchy. Before this legislative maneuver, citizens paid their taxes in one painful, transparent lump sum at the end of the year. The government leadership realized that high-visibility loss triggered immediate psychological resistance and political volatility. To neutralize this, they implemented the withholding system, a strategic power play to make the extraction of capital almost invisible to the naked eye. By siphoning funds before they even touch your account, the IRS, currently led by Commissioner Danny Werfel, utilizes a massive psychological buffer to hide the true cost of governance. This isn't just a collection method, it is a play of asymmetric information exploitation. They've successfully conditioned the average taxpayer to view a refund of roughly $2,852 as a windfall, a generous bonus from a benevolent board. In reality, you have been outmaneuvered into a position of extreme weakness, providing the U.S. government with a massive interest-free loan for 12 consecutive months. While you navigate the rising costs of living and stagnant wages, the state leverages your liquidity to fund its own operations, only returning the principal after its value has been eroded by inflation and opportunity cost. This is the ultimate forced savings trap, a corporate-style restructuring of the individual's wealth that ensures you never have the full leverage of your own earnings. You are cheering for the return of your own stolen property, completely blind to the fact that the house always wins by making you feel like you just hit the jackpot. But there was one detail in the 1943 law that didn't make sense, and no one noticed the hidden clause yet. The boardroom doesn't just manage balance sheets. It manages your cognitive biases with the precision of a surgical strike. This is where Richard Thaler's concept of mental accounting becomes a lethal weapon for corporate extraction. When the average American receives that $2,852 check, they don't see their own sweat and labor returned to them. They see a windfall, found money that exists outside the rigid constraints of their normal monthly budget. This psychological partitioning is exactly what Daniel Kahneman described in prospect theory. The perceived joy of receiving a lump sum far outweighs the incremental, almost invisible pain of the monthly withholding that funded it throughout the fiscal year. Marketing executives at major retail powerhouses understand this asymmetrical perception perfectly. They wait for the Internal Revenue Service to signal the release of over $242 billion in liquidity. Then they strike with the precision of a hostile takeover. They use loss aversion framing to convince you that if you don't spend that refund immediately on a depreciating asset or a luxury upgrade, you are losing the greatest financial opportunity of the year. It is an orchestrated maneuver designed to ensure that specific capital never finds its way into an IRA or a debt reduction strategy. By the time Danny Werfel's department marks your return as processed, the retail machine has already deployed its tax season campaigns to vacuum up your liquidity. You are being manipulated into a state of present bias, where the immediate gratification of a purchase blinds you to the long-term erosion of your personal equity. Retailers use loss leaders to lure you in, knowing that once you are inside the store with free money in your pocket, your internal gatekeepers are down. This is the windfall effect in action, a calculated psychological operation that turns your own hard-earned money into a tool for someone else's quarterly earnings report. These leaders aren't interested in your financial health. They are interested in the velocity of your spend. But there was one detail that didn't make sense about the fast cash promises, and no one noticed it yet. Inside the glass-paneled war rooms of Bentonville and Richfield, marketing executives do not view the spring as a season of renewal. They view it as a synchronized harvest of liquidity. This is the predator's calendar, a masterpiece of stakeholder manipulation designed to intercept your capital before it ever gains the chance to become an asset. These corporate strategists monitor Danny Werfel's IRS processing cycles with the precision of a high-frequency trader. They know that when the average refund of $2,852 hits a consumer's account, the psychological defenses of that individual are at their lowest due to the windfall effect. The most critical date on this calendar is not the April 5. This is the PATH Act deadline, the legal barrier that prevents the IRS from issuing refunds for the earned income tax. Corporate data scientists know this creates a massive, artificial bottleneck of demand. They wait for the predatory, fast cash lenders to prime the pump, and then the retail giants launch their offensive. They use a psychological tactic called loss aversion framing. By branding their campaigns as tax sales with expiration dates, they convince the taxpayer that failing to spend their refund immediately results in a loss of a potential discount. Everything they believed up to this point was wrong. This is where the corporate machine deploys the loss leader strategy, selling high-visibility electronics or vehicles at a near loss to lure the refund-heavy consumer into the ecosystem. Once inside, the consumer is upsold into high-margin warranties and financing agreements. It is a classic move in asymmetric warfare. While the consumer believes they are exercising their new purchasing power, the corporation is actually performing a strategic extraction, trading a depreciating piece of hardware for the consumer's most precious liquid capital. By the time the cooling period arrives in May, the retail sector has secured its quarterly surpluses, and the average taxpayer is left with a new monthly maintenance cost and a drained treasury. This is the cold reality of the boardroom. Your refund is not your reward. It is their target. To win in this environment, you must stop thinking like a consumer and start thinking like a corporate raider looking for a distressed asset. This is asymmetric warfare. In the high-stakes world of corporate restructuring, your tax refund is the only liquidity injection you receive all year. You cannot afford to waste it on depreciating liabilities. The first tactical maneuver is the undebt trap. While retailers use loss leaders to lure you into their showrooms, you must look at your personal ledger with the cold eye of a CFO. With credit card interest rates currently averaging over 20%, using your $2,852 refund to liquidate high-interest debt isn't just paying a bill. It is a calculated power play that secures a guaranteed, risk-free 20% return. In any boardroom, an executive who passes up a guaranteed 20% return to buy a new television would be escorted from the building. You are that executive, and your household is the firm. Next, you must establish a liquidity. Data from the Federal Reserve shows that 37% of Americans cannot cover a sudden $400 emergency with cash. This creates a psychological vulnerability that lenders exploit. By locking away part of your refund as an emergency fund, you are effectively creating a poison pill defense against predatory lending. It ensures that when life hits you with an unexpected cost, everything they believed up to this point about spending for the economy was wrong. What started as a simple annual payment was about to become a massive weapon for those who knew how to wield it. The third maneuver involves long-term asset acquisition through the lens of compound interest. Consider the math. A single $3,000 refund, if redirected into a retirement account at age 25, can grow to approximately $45,000 by age 65, based on a 7% average market return. This is what we call synergy weaponization. You are capturing the government's interest-free loan and forcing it to work for your future self, building a golden parachute that provides you with long-term organizational hierarchy over your own life. This entire strategy relies on a psychological principle called loss aversion framing. Retailers want you to focus on the joy of a purchase. To defend yourself, you must frame the spending of your refund as a literal loss of future freedom and a surrender of power to the corporate machine. Finally, you must invest in skill capital. Use your capital to acquire certifications or specialized training that increase your market value. In a world of systemic wage stagnation, increasing your personal leverage is the only way to outpace the inflation that erodes everyone else's wealth. If you don't treat your refund as a strategic asset for growth, you are simply a stakeholder in your own decline. The final move in this psychological chess match involves a tactical reversal that most taxpayers are too intimidated to execute. It requires looking at Commissioner Danny Werfel's IRS not as a looming authority, but as a counterparty in a negotiation for your own liquidity. Since the 1943 Current Tax Payment Act, the government has relied on a principle called the commitment and consistency trap. By automatically deducting funds from your paycheck, they establish a baseline of missing money that you eventually grow accustomed to, effectively training you to operate. This is the ultimate corporate power play, social engineering disguised as fiscal necessity. The forbidden secret to reclaiming your leverage is shifting your status from a creditor to a strategist by when you intentionally reduce your withholding to zero, out that average $2,852 refund, you are essentially firing the government as your interest-free money manager. Instead of letting them hold your capital for 12 months, you redirect that $250 per month back into your own accounts. In the world of high-stakes finance, this is known as capturing the float. By holding the cash yourself, you avoid the windfall effect that retailers like Walmart and Best Buy rely on to trigger impulsive luxury spending. You are moving from a position of forced savings, a term used by economists to describe those who lack the discipline to save without state intervention, to a position of absolute financial. But this shift isn't just about the numbers. It's about breaking the psychological subjugation of the refund cycle. When you receive a lump sum, you are vulnerable to marketing executives who have spent millions analyzing your present bias. When you receive a steady, increased stream of income, you build a fortress of liquidity that makes you immune to the debt spiral and the predatory interest rates of refund anticipation loans. You are no longer waiting for a handout from the state that was yours to begin with. You are managing your own executive treasury. Real power doesn't come from a once-a-year windfall granted by a bureaucracy. It comes from the quiet, daily control of your own resources. The boardroom is a battlefield. If you don't know the rules, you're already losing. Subscribe for more breakdowns of corporate power psychology. Tell us in the comments, what's the most